Good morning, David Moore, IRA Advantage, and thank you for joining us today. This 1-hour presentation on investing off Wall Street with your IRA. We're also going to be talking about 401k plans as well, but this is 1 hour to get through a lot of information. I always say that, but I get feedback once in a while. I speak quickly, and I guess what I'm trying to do is get enough information into you to understand, for you to understand the basics of the process, understand what's possible. But when it comes to the actual step-by-step of getting things done, that's something you're going to need to talk to us about for your particular transaction. So once again, I want to thank you for joining us today, and I'm speaking on behalf of IRA Advantage, and we're all about taking your retirement account and making it grow. We don't sell investments or give investment advice. We provide the investment vehicle, whether you're in a 1031 exchange with tax money or with your self-directed IRA or 401k plan on the retirement side. So for those of you that don't know me, and I see a lot of familiar names out there, my brother and I, Tom, started Equity Advantage in 1991. So we're celebrating 30 years in the 1031 business, and actually 1031s are celebrating their 100th birthday. So that's a pretty cool deal this year. We spent the year of 2021 pretty much fighting for survival in that business, making sure that it wasn't going to be chopped with the Biden tax reform measures. And for those of you that work with us in that space as well, rest easy, 1031's been preserved. Another issue we were very concerned about is elimination of the stepped-up basis, which was preserved. And what that means to you is, for those of you that handle tax-deferred exchanges throughout your life, you are going to have the ability, at least for now, to continue to defer the gain. And at your passing, your heirs would receive a stepped-up basis to current market value. They could sell the property or properties after they inherit it with no capital gains tax consequence. Obviously, you need to work with your financial people, your tax people, to make sure you're doing your estate planning as needed and understand what you have to do to keep your money yours on passing. But that sort of leads me to a very, very important comment. As I said, we don't sell investments or give investment advice. We're going to provide the investment vehicle. But I'm going to tell you that in my 30 years in investing, I think one of the most important people in your life is a great tax person. So you want to have good tax people you're paying for opinion, not paying to learn on your behalf. But take advantage of them, not on April 15th. Really talk to them this time of the year before year ends, so you can look at your gains and losses and make sure you're not paying any more tax than you have to on those things. I've got a good friend who's a lawyer on this call too. Connie, I see out there, and I want to stress that good legal people are another critical element to your success in this life. And you might say, well, gee, I can go use LegalZoom or something like that. Well, when you're working with the type of stuff we work with, you need somebody there that's going to really understand it. Once again, if there's an issue that we look at upon a proposal on a deal, we want you to have good legal people as well. We're going to talk about finance people. You want people that are going to take care of you, that you don't have to sort of reinvent the wheel every time you go buy something. If we're talking about financing and retirement accounts, understand that it's not going to be through a normal channel. It's got to be non-recourse debt. These are specialized lenders or banks that are going to specialize in that and give you the ability to use your money in a non-recourse nature. We'll talk about that a little bit more in a while. But good, if we're talking about real estate, you got to have good title escrow people, and obviously those brokers too. But you talk about these things when you consider an investment. Don't think about it when you're buying or selling something, because it takes time. If you come to us and you want to use your retirement account to go buy a piece of property, for example, you've got to figure it's going to take about a month at least to get things set up, and you really should be set up before you go make the offer. So I just want to really instill the importance of a good team of people. Sometimes people object, well, gee, it costs some money for good tax or legal people. Well, it's going to cost you a lot more if you don't have those good tax or legal people over time. So I always like to say the only dumb question is the one that's not asked. So ask the questions. As you can see on this title page, you've worked hard for your money. We work hard to keep it yours. And we're going to look at that either, as I said, via 1031 in the tax world, or we're going to look at it with your retirement accounts. But hopefully we're going to be able to help you get where you want from where you are to where you want to be in 2, 5, or 10 years. And really the best way to get there is with knowledge. So thanks again for joining today. And we're going to hit it right now. Investing off Wall Street with your IRA. So first thing I want to say, when we're looking at retirement accounts, self-directed is not a legally defined term. It's just a term that describes an account that allows you to buy what you want to buy. So if we look at, in the most basic sense, a self-directed retirement account, if you've got an IRA and you want to go out and buy some investment fund, obviously you're going to do that through traditional Wall Street avenues. But if you want to go out and buy real estate, make loans, buy notes, you want to go buy crypto, you want to do a business startup, any of those things, you're going to require a self-directed account. And if we look at that, since it's not a legally defined term, it's just a term that describes an account that allows you to go do what you want to do. And there's many firms out there that say, well, we've got a self-directed IRA. Well, if that self-directed IRA just allows you to buy off that investment provider's menu of options, it's not a truly self-directed account. We're talking about an account that literally allows you to buy anything the law allows. And that's a very, very broad definition, which we'll get to. So truly self-directed means it's an account that's going to allow you to buy whatever the law allows, not what that custodian or trust company might lock you down into. If we're talking about 401k plans, we're looking at a plan that's either going to allow you to make an investment or not make an investment. And if we look at that plan, it doesn't allow you to make the investment you want. Our first question is going to be, can we amend the plan to allow it? If we can't amend the plan to allow it, can we replace the plan? And the answers to those questions might be dictated by what type of investments you want to make. Now, if you're a business owner and you've got a 401k plan and you want to go out and buy real estate with your plan, you can obviously make the change to allow that plan to do it. But the next question would be, does your administrator or trust company want you, the trustee of the plan, not trust company, but do they want you to be able to buy these things? And what does that do to the liability of your business? So those are questions, once again, where we're going to get back to that good team of professionals at the beginning, whether your legal people are comfortable with what's going on there. So understand in tax law, there's lots of gray, but when we're looking at protecting you and protecting your money from liability or other issues, that's something you're going to work with your legal people to really take care of. And as far as your tax people are concerned, they're going to be looking at this stuff, and we're probably going to spend a lot of time with them talking about what has to happen with a self-directed account that maybe doesn't with a just Wall Street basic IRA. So if we're, once again, a self-directed account, we're just going to move from a custodian that won't allow you to buy what you want to one that does. If we're talking 401k plans, quite often we're talking about replacing that plan. So how and when can I create a self-directed IRA? Any IRA can be self-directed. When we're talking about 401k plans, it's a much more sticky situation. So if you're happily employed, you've got a current 401k plan and you're under 59 and a half years old, you're stuck. If you're over 59 and a half, we can do an in-service rollover. We can take that money and move it into a self-directed IRA. If it's a previous employer plan, you have that access to that money and you can roll that money into a new IRA, or maybe if we're doing a rollover business startup or you're going to be self-employed, maybe we do a solo 401k, we're just going to move the money from one 401k plan to the next 401k plan. So I say we, but you're going to have to initiate that transfer. And if we're talking about a solo 401k or we're talking about a rollover business startup, a lot of those, you're the trustee of that plan. As trustee, you're going to direct the current administrator or trustee to move that money from where it is into your new 401k plan. If it's an IRA, typically we're going to have a transfer authorization form that allows the new trust company go to the old trust company and say, hey, give me the money. But your responsibility in that situation is to have the money available. So we don't want that transfer authorization to happen until you've gone to cash in. The easiest way to move money from custodian A to custodian B is to go cash. If you've got things that can't go to cash, we can do in-kind transfers. It's just more cumbersome, obviously more time consuming. But once again, happily employed, current 401k plan under 59 and a half, we're stuck. Over 59 and a half, we get access to that money. Previous employer plan, we can move that money. Now, just a word of caution, I've had twice now in the last few years, I've had a potential client want to self-direct their 401k plan. They resign from their current job and they go take a new job in the same sort of space. And twice now I've had people that don't give the time in between that resignation and the new acceptance of the new job. They take the new job before we've been able to get the money out of the old plan. And if the new company is the same parent company as the old company, it's possible that plan's, you take the new job, we can't get access to it. So really understand your situation. If you're going to step away from a job, especially if you're stepping away from it to get access to money, make sure that the thing gets set up, the money gets out before you take a new job with the same company that locks up your money once again. So unfortunately, this is something that happens. And I always say I'm happy to learn. I get tired of being taught things, so hopefully I get information out to my clientele, and they can avoid the pitfalls that we've seen through the years. Bottom line, I mean, if you look at retirement accounts, you look at self-directed, we really want to understand what you're going to buy, and you need a truly self-directed account. If you're going to go buy gold, buy crypto, buy any of these things that Wall Street doesn't sell, you've got to have a truly self-directed account. The other thing is you're putting money into these accounts. Your whole life you're putting money into it. And if it's traditional IRA or 401k, it's pre-tax money growing tax deferred. Roth money just means you've paid the tax, and now the growth after you've paid the tax on it is going to be tax free. So that's really the difference between those two accounts. But we've got to look at where you are in the investment life, in your investment life, for example, and a Roth IRA might be a very good idea if you're young, and or you've got some investment that's going to explode in value. But if you come to me in your late 50s or early 60s, you start talking about doing a Roth conversion, I'm going to question that. I'm going to question whether you want a self-directed account or you just want to pay the tax. If you're 59 and a half, there's not going to be a penalty. So instead of doing a Roth conversion at that point in your life, going for that tax-free thing, but having all the strings that a 401k or IRA has, why not just take the funds as a distribution? Now you got the money to use as you choose. And does anybody think tax rates are going to go down? And probably not. Now we've got inflation that's obviously biting at us right now, so that's obviously a consideration too. But you've got to really look at things. And although I sell IRAs and 401k plans, I'm a real estate guy, so I'm not necessarily a huge fan of them. But that sort of leads me to this point. If you look at a retirement account, you look at what you can buy with it. I mean, any investment provider is going to say diversification is the ultimate, gold ticket to success, right? And so if we're talking about taking money and going self-directed on something, you need to understand it's not all or nothing. You're going to move what you choose to move. You don't have to move at all. So if we're talking IRAs, I'm going to encourage you to keep your Wall Street stuff with your Wall Street advisor. We're only going to self-direct what you want to use in a self-directed capacity. And I say that for a couple different reasons, which we'll get to. If it's a 401k plan, there's really no reason that you would segregate that. We're going to move all your money into the new plan, and then you can have Wall Street money, Wall Street investments in that plan, and all your self-directed stuff as well. But it makes a big difference between IRAs and 401k plans on what sort of course of action we're going to take. Why a self-directed account? Well, we are sitting here doing this presentation, and it is December 22nd, and we've got a situation where the stock market's been going up and down. I mean, this morning when I looked, it was green. The last couple of days, the last week, it's been red, but it has a tendency to go up and down. Why is that? Well, because Wall Street's considered liquid. Real estate, for example, is not considered liquid. So, the benefit of liquidity is you buy and sell what you want when you want with really no consideration. So you can pick at that date, literally, the time when you're going to realize a gain or a loss. Where with Wall Street, you got to put with real estate, not Wall Street, real estate, you got to put it on the market and you got to get somebody to buy it. So it's not considered to be a liquid asset. And that's one of the objections Wall Street people have about putting money into real estate or other hard assets off of Wall Street, because they're not necessarily that liquid. But we're going to talk about why that's really not an issue. But if you look at why people want to do this, tired of the roller coaster, greater financial control, invest in what you know. Think about this. If you've got specific knowledge in hard money lending, for example, you might be a mortgage broker and you want to take your retirement account and use that money for loans, you can do that. Well, if you've got specific knowledge on something on Wall Street, you're going to be guilty of insider trading. So you've got to be very careful when you're looking at Wall Street investments, where if we're looking at self-directed investments, if you've got specific knowledge that gives you an advantage, why not use that advantage? And that's one of the great things. So greater financial control, invest in what you know, increased investment flexibility. Our accounts are going to allow you to buy anything the law allows. If we talk about advertisements we see on TV or here on the radio these days, I'm sure everybody on this call has been watching and seen ads on gold or silver. You listen to the radio, you're hearing ads on gold and silver. So those things, what are they selling there? They're selling tangible assets. They're inflationary hedges. Well, what's real estate? Real estate is sort of the ultimate, tangible asset inflationary hedge. You don't even have to bet it's going to go up in value to make you money. You've got somebody else making payments, and you've got other things going on there with that real estate. You will have appreciation over time, but I like to say it's the ultimate tangible asset. Real investments are not alternative investments. Why is it that in the investment world, like say gold, silver, real estate, all these things are considered to be alternative investments, which I believe sort of makes them sound a little bit less hardy or impervious to problems over time. I would say that real estate and gold, I mean, these things are the oldest investments known to man, and they are hard assets. And for you to lose unencumbered real estate, the only way you're going to do that is by not paying property taxes, and it's going to take a while for the government to take that thing. Where stocks can go up and down instantly, minute by minute, second by second. So that's one of the things people like. Community-based investing. If you want to make a difference in your community, you can literally make a difference in your community by making loans or building things, creating a new business, so that you literally can make a difference in your community. Take advantage of today's opportunities. Obviously, talked about tangible assets, security. What do I mean by security? If you've got a truly self-directed IRA or 401k, that money is literally where you put it. You've got a bank you like to work with, you open the account at that bank. So the institution you're working with is literally where you want it to be and who you choose it to be. Work with who you want to. And as far as security is concerned, you're going to find that balance of services and security. You're going to put it where you know it is and where you know it will be. Cryptocurrency, you want to go out and buy crypto, a self-directed account is going to allow you to do that. So even that's something that's possible. A new business, rollover business startups, ROBs, we're going to talk about that today. That's an option for you. So what are the common objections? So if you talk to somebody, maybe it's your CPA. I mean, maybe it's your financial advisor, maybe it's your lawyer, maybe it's a friend. What are common objections to self-directing account? And the first one is typically going to be something along the lines of a loss of long-term capital gains tax rates. And I hear this question all the time. Well, why would you take your IRA and go buy real estate with that IRA when you lose long-term capital gains tax treatment on that? Well, that's true, but can anybody name an investment you make with an IRA 401k that gives you those long-term capital gains tax rates? The answer is no. So that's a pointless statement. It's really irrelevant. And the tax treatment on anything you buy with that account is going to be the same. Doesn't matter if it's Wall Street, doesn't matter if it's real estate, crypto, whatever it might be. So loss of long-term capital gains tax rates, yes, you do, but you're not going to get that with any IRA 401k owned asset anyway. So it's really not a question of that. It's really a question of what's the highest best use for that money. Second objection, well, why would you buy real estate with an IRA or 401k when you can't leverage that? That's totally untrue. It's just got to be non-recourse debt. And something to keep in mind, what that means is that that loan should not be attributable to your income, your credit. It's not going to be anything where you're on the line for it. So if you're pledging anything that's yours, it's going to be a prohibited transaction. Non-recourse debt means that in a default, the only thing the lender can do is take that property that they've made the loan on. They can't go after anything else the IRA or 401k has. They cannot go after you for that. So typically we're looking at a lower loan to value, maybe a slightly more expensive loan. And something to keep in mind is that with an IRA, you're going to have tax exposure on income or gain attributable to the leverage. So what I mean by that is if you've got a loan on a property, it's 50% loan to value, half the income is going to have tax exposure and half the gain would upon disposition. You're saying, well, gee, I've got a Roth IRA, I don't have to pay any tax. Wrong. You're going to have tax exposure on the income or gain attributable to other people's money. Now, one of the reasons I like solo 401k plans is that you do not have that tax on leverage with a 401k plan where you do with an IRA. So this is one of the many differences between IRAs and 401k plans. So what's another objection? What about RMDs? Since real estate's not liquid, for example, you've got your money tied up in a property and now you turn 72 and a half, or 72, and yes, I did say 72. The laws have changed with respect to distributions that, let's say you don't have any cash in the account. You now have to take that RMD, the required minimum distribution. Well, what do? Well, you take an in-kind distribution. So if you've got a piece of property, for example, you could deed a piece of that property as a distribution to yourself, or you could, if it's owned by a limited liability company, simply do an assignment of membership interest. I like the assignment of membership interest. If you've got a checkbook IRA, keep in mind really what's happened is we put an IRA-specific limited liability company between the trust company and the ultimate investment. The manager of that limited liability company would be you, the investor. So as manager, you got the power of the pen to go do what you want when you want. Now, if we have, let's say you got 10 properties in a checkbook IRA, so 10 properties owned by that LLC, and you just do a simple assignment of membership interest of that LLC, now you've taken a piece of everything. So what I typically would say is, look, if you've got a property that you want to retire into, or you want to take it as a distribution, let's put that property in different limited liability companies. So your checkbook IRA LLC would have as one of its assets this other LLC that owns the asset. And then if you want to take that asset as a distribution, you simply do assignments of membership interest in that limited liability company. You don't even have to change title of the property. So that's why I like that structure. And it even gets better with some discounting possibility if it's a minority interest distribution. So lots of opportunities there. Lose interest deductions, depreciation. Well, that's true, but once again, what are you going to get? What are you going to get interest deductions, depreciations on with your retirement account assets anyway? Now, it's not entirely true because it's possible that if you have a leveraged investment with your IRA, your tax people might look at it and say, okay, we should take interest deductions, depreciation to offset that tax, that unrelated business taxable income that was the income or gain attributable to the leverage. So there are situations where maybe that stuff exists. It's not an absolute. So, these are just 4 objections that are the typical ones that I deal with day in, day out. And I wanted you to understand why those things might be an issue and why, really how to approach them and understand what if somebody says they got a problem with it, how you're going to deal with that. So I like simple, all right? If I'm talking about a retirement account, I'm looking at 2 issues. What does the person want to buy? And 2, who are they transacting between or for the benefit? That's really what's important. And I like to tell people, don't think of your retirement account as yours. Think of it as, I always say, Susie down the street. Think of it as somebody else's, because if you think of it as somebody else's, you're much less likely to commit a prohibited transaction, which really a prohibited transaction, we'll talk about them. But if we're looking at a Wall Street IRA or 401k plan, it's virtually impossible for you to commit a prohibited transaction. It's obviously possible to make a poor investment, but you're not going to have prohibited transaction situations where if you've got a truly self-directed solo 401k plan or a checkbook IRA, there's very little of any safety net there. So you've got to be diligent anytime you pull out, if you've got a checkbook IRA, every time you pull out that checkbook, what am I writing the check for and who's it to? And anything that involved a prohibited transaction is typically going to be around a situation where it's a benefit to a disqualified party. So we'll talk about that in a moment. But once again, I look at these 2 issues. What does the person want to buy? And 2, who are they transacting between or for the benefit of? Those are the primary issues. So possible investments. What do you want to buy? IRAs can literally invest in anything other than collectibles, life insurance contracts, or stock in a sub-S corporation. So the way the law works, if it's not specifically prohibited, it's therefore allowed. most of the time people come to us, they want to buy real estate, they want to make loans, they want to do something with crypto or gold, precious metals. So, those things are all going to be possible. Now with precious metals, they have to be investment grade. It's got to be IRA 401k compliant. You can't just go buy some collectible. Like I said, collectibles are prohibited. So it's important that if you're buying metals, you're buying from a dealer or broker that understands what is or is not IRA 401k compliant in that space. But literally, if it's not excluded, it's possible. So collectibles, life insurance contracts, or stock and sub-S company. 401k plans actually are even more liberal. The only thing you can't buy with 401k plan is collectibles. So really, you name it, your IRA 401k can probably buy it, and whatever you're buying has to be simply for investment purposes. So I said, 1, what are you buying? 2, who's it to benefit to, right? So if there's a benefit to a disqualified party, it's a prohibited transaction. So who's a disqualified party to your retirement account? Well, you would be your lineal ascendants, descendants, their spouses, your spouse, or any legal entity owned and controlling interest by one of those. So any transaction between or for the benefit of a disqualified party would constitute a prohibited transaction and would be problematic. Now with an IRA, the big problem is that a prohibited transaction will take and distribute all funds in the account as of the first day in the year in which the indiscretion occurred. So you don't want to do this. 401k plans, it's only the money involved with the indiscretion is treated as distributed. So the tax consequence of a prohibited transaction is dramatically different with a 401k plan than it is with an IRA. Either way, don't do it. You don't want to do it. So that's why every time, like I said, with a checkbook IRA, you pull that check out. Who am I writing this check to? What's it for? And if there's a benefit to a disqualified party, it's a problem. Now, if you think about who I said was disqualified party, what you might find interesting is that I did not mention cousins, aunts, uncles, even siblings. Even siblings are not disqualified parties to you or your retirement account. So it's very interesting that those people are okay. So we're just talking lineal ascendants, descendants, their spouses, or any legal entity owned in a controlling interest. You want to stay away from those. You can't go buy a property for mom to live in. You can't buy a property for Junior to live in while he's in college. So that would be a prohibited transaction. Now, if your brother or sister was on dire strait, you want to buy them a property to live in, that's fine. You can do that. You ought to, charge them some rent, but those things, siblings, aunts, uncles, cousins, are fine. Now, the other thing I want to mention is it's a prohibited transaction to transact between or for the benefit of a disqualified party, but it is not a prohibited transaction to transact along with one. So what I mean by that is it's okay if you want to combine personal money and plan money to go buy a certain asset. That's totally fine. You just can't sell to, buy from, loan to, or borrow from a disqualified party. You can't buy a piece of property and use that thing. But as far as joint ownership in an asset, that's fine. You just need to overfund whatever the entity is. And there's 2 ways to do it. There's a couple of slides talking about that we'll get to in a minute. But really, it's Tennessee in common or as common members of an LLC, and each has ups or downs. So problems, pitfalls, traps. Where do people have problems with these things? And as I said, every time if we've got a checkbook IRA, every time you pull out that checking account, that checkbook, you've got to really be clear on what you're doing with this. And you can't have a check, any transaction should never be one between you and that account, period. So common problems are people will borrow from their IRA or sell a property to it or buy a property from it. All those things are not okay. Receiving unreasonable compensation for managing an asset. I don't want to see any compensation. This is one of those things where our legal counsel says, well, gee, sweat equity. Sweat equity is not okay. So if you want to go out and flip properties with a retirement account, you cannot work on those properties. Sweat equity would constitute a prohibited transaction. So it's really important that if you're going out and you're buying real estate, you can manage the asset, but you cannot get dirty on it. I mean, you can't work on it. Don't pound nails, pull out the paintbrush or anything else. You might say, well, gee, how does anyone make a problem? How do they know? And why would it be a problem? Because you think, well, gee, if sweat equity is going to increase the value of my account, which ultimately converts to more tax revenue for Uncle Sam, why would that be a problem? Well, the problem is that you're not paying somebody else. They're not getting the normal income tax from those other vendors that are getting paid today, and they don't want to wait for that tax revenue. At least that's the way I would look at it. So just keep that in mind. And back to the comment on, well, how do they know? Well, I mean, you get audited and somebody looks at the ledger for the checkbook IRA and they see, well, you had an invoice to Sherwin-Williams for $500. Where's the corresponding labor? That's how it gets to be a problem. So you don't want to do these things. The cost of a problem is too great. As I said, with an IRA, you in effect blew up the entire IRA as of the first day in the year in which the indiscretion occurred. So you don't want to do these things. 401k plans, again, is just the money involved. But that management component, I really don't want to see, anything ever between you and your retirement account. Using money, using something, having recourse on a loan, or having the property securing something else for a disqualified party. All these things are problematic. Buying a property, as we said, for personal use is going to be a problem. So just think of it, as I said, Susie down the street. Susie's going to invest in what Susie's going to invest in, and you want to make sure that whatever the yield off that investment is always Susie's too. So when you're making a common problem that we see, and it's common to the point where trust companies sort of have a correction form to do it, is let's say that you want to make an additional contribution to your IRA. Well, with a checkbook IRA, you literally have a checking account at the bank of your choice, and you might write a check into that account. That's a prohibited transaction. If you want to make a contribution to the IRA, it's got to go to the trust company. The trust company then makes an additional investment in the LLC, which funds that account. So therefore, on a distribution, you can't just write a check out of the account out either. The money has to flow from the IRA LLC back through the trust company to you. Now, 401k plans, it's different, because 401k plans, our plans are self-trustee. You've got a bank account in the plan's name and EIN, and typically our clients, the trustee of the plan, you just write a check to make a contribution into that plan account, and then distributions can be taken straight out of that plan account. Now, once again, you do not want to do that. Do not take distributions before you're 59 and a half, or you're going to pay tax on that distribution at normal income tax. You're going to have a 10% penalty on top. So be very, very careful in those situations. So that UBIT issue at the bottom on this page. So UBIT is typically going to be driven by if you're conducting business or you've got leveraged investment. So you're saying, well, what do you mean conducting business? So let's say you buy an apartment complex and you've got a laundromat as a component of that apartment complex. So the laundromat's part of the investment, everything's fine. Now you say, well, gee, I like the laundromat, so you go out and buy a laundromat. You're conducting business. So even though that laundromat could be owned by your Roth IRA, for example, that would have tax exposure because you're conducting business instead of investment. The government does not want these tax privileged entities competing unfairly with the taxed world. So we'd have that UBIT issue in that situation. And then once again, on leverage, any income or gain attributable to other people's money, you're going to have tax exposure on that too. So how do we do this? And I sort of mentioned it earlier. Really, it's pretty easy. It just takes some time because nobody seems to move very fast these days. So if we look at what is involved, if you're working with us to create a self-directed IRA, you're going to fill out a 2-page application with us. You're going to return that along with the current your current account's most recent statement. And then we're going to want a copy of a photo ID. We're going to take the information out of all of that, merge it into our contracts and some other forms, and then we're going to get those forms back to you. You're going to then sign those forms. They've been bright lined where we need additional information and or signatures. You fill those forms out, return them to us. We need wedding signatures, so we need the originals on that. The application we don't, but on the additional information come in, and we need the original signatures on that. And then one of those forms, like I said, the transfer authorization form, which allows the new trust company to go to the old trust company and say, give me the money. And as I said earlier, it's not all or nothing. It's just what you choose to use in this capacity. So they're going to move that money that way. As the money moves from trust company A to trust company B, if it's a basic self-directed IRA, we're done as soon as the money hits the account. And you're going to have online access to your account in the future as soon as that's established. Now, if we were doing a checkbook IRA, we're going to add an additional step. We're going to create that IRA LLC, which is an IRA-specific operating agreement on that LLC. We're going to get you the federal tax ID number for it, the articles of organization, and we're going to get you that information, and you will have gone to a bank, open a bank account, the LLC's name and EIN. You as manager of the LLC have the ability to sign on that account. The member of the LLC is going to be the trust company for benefit of your IRA. But really, if we're talking about a self-directed IRA basic, we're just moving that money. We're creating a new custodial account with self-directed custodian, moving the money from custodian A to custodian B, and we're done. If we're doing a checkbook IRA, as I said, we're, in addition to those bubbles on the left going, whether it's IRA, Roth IRA, 401k, that money's moving into the trust company. And by the way, if you have traditional funds and Roth funds, and you want to combine both of those into a single checkbook IRA LLC, we would have to create a custodial account for the Roth money, a custodial account for the traditional money, and then both those accounts would be making an investment in that new IRA LLC. So that IRA LLC could contain any number of accounts. Maybe you and your spouse want to put money into a common investment. Well, we would do one IRA LLC probably, age dependent. What I mean by that is if we've got that IRA LLC and it contains multiple entities, and those entities are disqualified parties to one another, which, by the way, your Roth and your traditional are disqualified parties to each other, we can combine them once again into a common investment. They can be combined and invest together into something, but you couldn't, sell to, buy from, loan to, borrow from, any of those prohibitions I mentioned earlier. And furthermore, after the initial funding of that LLC, if it's got disqualified parties as its members, we cannot have additional money come into that LLC. Future contributions would indicate a prohibited transaction, so we don't want that to happen. So if you say, David, hey, I need $250,000 to make this investment, and that's good. I'm going to say, well, maybe we ought to put the 250 in there and add another 50 just in case, because what happens if it's for some reason that investment needs some money, you can't add additional money to the LLC to save it in the future. So we've got to overfund the LLC, so we've got the money to make the investment, cover any projected carrying costs until that asset has enough cash flow to be a cushion there to take care of things. So years ago, I had properties, this is probably 25 years ago, some stuff in Hermiston. We had a hailstorm come in and destroyed the roofs on all these plexes we had out there. Well, that was an unforeseen circumstance. And obviously with tax money and just money out of my pocket buying the things, I just had to find a place for the money, find money for the repairs. But if I'm talking about an IRA 401k owned asset, let's say it's checkbook IRA, multi-member, now I have to have a way to get the money there somehow to fix this thing. So really don't stretch yourself out to make the investment. Make sure you've got enough to make the investment and cover carrying costs till you've got a cushion there to make sure everything's going where it needs to go in the future. But this is a checkbook IRA. So a checkbook IRA is also called an IRA LLC. And as you can see through this bubble chart, we're creating custodial accounts with a new self-directed custodian. We're directing the custodian to make a single investment into this checkbook IRA LLC that will have a bank account at the bank of your choice. And you're the manager of the LLC. The member is a trust company for benefit of your IRA. Now, as soon as the LLC is funded, you want to go buy real estate, you just negotiate the purchase in the LLC's name. You want to make loans, you want to buy crypto, gold, whatever it is going to be owned by that limited liability company that you're the manager of. So any yield off those investments is the LLCs, any expenses, the LLCs. And by the way, if you've got a leverage investment, you've got that UBIT, unrelated business income, taxable income, whatever you want to call it, it's not your tax obligation, it's the retirement account's tax obligation. So we want to make sure there's enough money in there to cover the obligations that are there. And if it's a single member checkbook IRA, we can always add funds. But if it's multi-member with disqualified parties, we've got to make sure we've got enough in there at inception to cover that acquisition and any potential problem that might come up. How about a solo 401k? Now, you've heard me talk about these a little bit. If you're self-employed with no employees, I'm going to shove you towards a solo 401k instead of an IRA. And I say that for a variety of reasons. We cannot move Roth IRA funds into a 401k plan, nor can we move a beneficiary IRA, one that's been inherited. We can't move either one of those into a solo 401k. But any other 401k can be rolled into it, and then traditional funds obviously are able to be rolled into this thing. Now, if we've got a solo 401k, you're just going to end up receiving a plan document from us. You're going to have a tax ID for that plan, and you're going to open a checking account in the plan's name and tax ID number, or it could be a savings account, whatever you want, at the bank of your choice. And just like the checkbook IRA, you've got the ability to make investments simply by writing a check. Now, for your Wall Street stuff, in the IRA space, I'm going to tell you if you're only move what you want to use in the self-directed capacity in the checkbook IRA, because as I said earlier, a prohibited transaction is very costly with an IRA. So I want you to keep your Wall Street stuff with your financial advisor, only move what you want to use in the self-directed space. Now, 401k, I'm going to say, look, why maintain a whole bunch of IRAs in different accounts, shove it all into the 401k plan, then reestablish an account with your financial advisor in the 401k plans and IRA, 401k plans name and EIN. And that way everything can just simply go from one account back and forth, and you've got everything where you want it to go, and you don't have to worry about encumbering the Wall Street stuff with your self-directed, because as I said, if you commit a prohibited transaction with a 401k plan, it's only the money involved within discretion is treated as distributed. So needless to say, I really like these. Another reason I like the 401k plans, you can borrow against them, half what's in them, to a max of $50,000. Can't do that with an IRA. And you don't have a custodian, which is another expense, and it's nice and just less cumbersome. And you can make your max contributions up into the high $50,000 range with one of these things when you're looking at max contributions. So they're very attractive for a variety of reasons. If you've got employees, you're probably going to be looking at a SEP IRA instead of a solo 401k, because if we put a 401k plan together for you, anybody that's a participant in the plan has to be able to make any investment that you're able to make. So, let's say it's real estate, and you don't want your employees to be making those investments. Your trust company or your trustee doesn't want you to, because of liability. You've got to be aware of that thing. So whatever's good for the boss is good for everyone else, and that's why if you've got a business, maybe you're self-employed, but we might be looking at a SEP IRA instead of a solo 401k if you've got employees. So sort of switching up a little bit, because part of this presentation is combining 1031 money and IRA 401k funds into a common investment. So what's an exchange? 1031, as I said at the top, 100 years old this year. So 1031 applies to any property, any real property that's been held for investment, and you're going to acquire any real property with the intent to hold for investment. It's been around since 1921. It's an amazing tool, and you've got some basic things that have to happen. But we can combine personal money and plan money into a common investment. We can combine a 1031 into the same investment you're making an investment into with your retirement account. We can't have a 1031 into a property owned with a retirement account, or vice versa. And the 1031, if it's involved, is going to require a tenancy in common structure instead of membership interest in LLC, because partnership interests are specifically prohibited. But 1031 is, I like to say 1031 is sort of the IRA or 401k for the real estate world. So when I look at the retirement accounts, I said two issues: what are you buying, who are you transacting between, or for the benefit of. When I look at 1031, I'm looking at four issues. One, it's got to be an exchange. As far as you're concerned, if you've got a piece of property that's appreciated and you don't want to pay the tax on disposition, we can do the exchange. So you're going to list and sell as you normally would. We're going to step in the middle of the thing and turn it into an exchange for you. So you give us something, we got to give you something back. Two, what's going to receive have to be of like kind. The like kind requirement's very broad. It refers to the nature of the investment rather than the form. So any real property held for investment is like kind with any real property acquired with the intent to hold for investments. You can go from dirt into apartment buildings, office buildings, a place at the beach to retire into. All those things are going to be fine. 3, for total deferral, you need to go across or up in value and equity. 1031 is not all or nothing. Remember, with the retirement accounts, I say you didn't have to move all of it. 1031 is not all or nothing. Think of it from this context. Whatever your tax basis is in a property, every dollar you spend over that basis represents tax deferred gain. For you to be totally deferred, you need to go across or up in value and equity. Those two numbers are net of closing costs. But if you said, David, I want to pull $10,000 out, take a trip, you can pull the 10 out. You're going to pay tax on the 10, the balance of the funds, the balance of the gain, as long as you meet the napkin test value and equity requirements, are going to be totally deferred. Finally, we have to have continuity of vesting, and that just means that the person or entity that gave us something has to be given something back. So retirement accounts, 2 issues. What are you buying, who are you transacting between, a benefit of? 1031, we're looking at 4. It's got to be an exchange. Items relinquished and received must be of like kind. And once again, like kind, we can convert an investment into a residence. We can convert a residence into an investment, and there's reason to do both those things. It just takes time. The napkin test, across or up in value and equity once again. And one of the biggest misunderstandings in 1031 is people always say, well, you have to replace debt in an exchange. That's totally untrue. Debt can go away 2 ways. One, by going down in value, triggers tax because you went down in value. The other way debt goes away is by adding cash, which is always fine. And then finally, continuity of vesting. Biggest headache in any exchange is time. The second biggest is vesting. And that just means that the person or entity that gave us something has to be given something back. And it sounds easy enough to satisfy, but it's just not, because those with the gold make the rules. And a lot of times the lending community is in opposition to the tax or legal community, what the IRS wants to see happen. So joint ownership of real estate. If you want to combine personal money and plan money into a common piece of property, you've got really 2 options. Tenancy in common, which means both are going to be direct deeded owners of the asset, or as common members of an LLC. Now, I like the tenancy in common structure, but you should have a tenancy in common agreement. That's going to read something like an operating agreement for a limited liability company. So it's going to spell out the operation of this. The reason I like the tenancy in common is because you can have a joint checking account with planned money and personal money in it to pay all the bills. And you're going to have all the ins and outs in and out of that account. And if you needed to add money to the investment for some reason, you would just go pro rata contributions in and make that happen. If we have a joint ownership via limited liability company, we've got those same issues that we have anytime we combine multiple disqualified parties into a common LLC. So we need to make sure we overfund that LLC so we've got enough money to make the acquisition, make things happen. Now, another reason I don't like the LLC as well as the TIC is that the TIC allows you to exchange in, and probably more importantly, be able to exchange out of it in the future. If you're a joint owner of the property, tenancy in common with your retirement account, upon a sale, your retirement account's money is going to go back in the account and have whatever tax consequence it might have, but you've got the ability to do a 1031. If the LLC owns it and has both you and the retirement funds as its member, the LLC would have to do an exchange, or you're going to have tax exposure on any income gain, the gain attributable to your ownership interest. So there's several different reasons I like that tenancy in common better than the LLC. But on distributions, as I said earlier, it's very common for our clients to take pieces of a property as a distribution, and the easiest way to do that is through assignment of membership interest in the LLC. So there's 2 different ways. Each has its ups and downs, and that's why, you know, the only dumb question is one that's not asked. You give us a call if you're contemplating these things. We can talk you through the ups and downs of each and sort of help you figure out which way is going to be best for you. We'll arm you with some information you can go talk to your tax people about, your legal people about, and decide what course is best for you. So once again, I do want to stress the bottom of this slide just says cannot 1031 into or out of a membership interest. So partnership interests are specifically prohibited from 1031 treatment. That's why if you want to combine the personal and the personal money via 1031 into a common investment with your checkbook IRA, then it needs to be tenancy in common, where if you're just pulling money out of your pocket, you do have the ability to pick tenancy in common or membership in the limited liability company. Contingencies, really, if you're making an offer, if we're talking about real estate, you want to make sure you have something in there. Number one, make sure that the investment vehicle is ready to go when you make the offer, because you can't personally tie up a property and then assign it over to your retirement account. That would constitute a prohibited transaction. So you want to make sure that if you've got a basic self-directed IRA, we really haven't talked about because I rarely have people do it, but a basic self-directed IRA means all we're doing is creating a custodial account. To make any investment, you've got to submit the investment to the trust company. Upon their approval, they'll make the investment. So if it's a basic account, we need to make sure that you've got a contingency of the purchase sale agreement stating that this offer is subject to the custodian's approval, so you're not on the hook for that lost earnest money. If it's a checkbook IRA LLC, you don't have to ask for that. If it's a solo 401k plan, once again, you don't have to ask for that. If financing is available, even though most state forms for brokerage for real estate have some type of boilerplate financing contingencies in there, we need to specify that it has got to be, it's subject to your ability to get an IRA specific non-recourse IRA 401k compliant loan. So you can't just rely upon that other stuff, all right? Finally, time. And I always joke with people, anybody out there that scuba dives, know you plan the dive, then you dive the plan. If you're a pilot, you're gonna file a flight plan. If you've got a boat, you're gonna do the same thing with float plans. So in this space, you need to make sure that you're ready to go. And inevitably what happens, people will call up, ask questions about what they can or can't do. Then I don't hear from them until they're ready to make an investment. And you know, that property, especially in today's market, I mean, properties just are not on the market for very long. So my advice is get this thing set up, ready to go before you start shopping, because inevitably you're going to find something before it's ready to go, and it's going to take a month to get it set. So there's going to be lots of frustration, and you're going to be tempted to, you know, put money down and then assign it over. Don't do that. Let your brother, sister do it, aunt, uncle do it, cousin do it, somebody other than you or any other disqualified party. So just, you know, ask for whatever time. Don't get things set up, and, you know, get it set up, ready to go before you're there writing offers. It takes time. Business or investment. So if you're flipping property and you want to flip property with your IRA, is that an investment or is it business? And this is a conversation I have often, and we have all heard the ads on the radio or seen the ads on TV about people flipping property. Well, that's a business. It's not an investment. No matter how long it takes you to prep the property for sale, you're holding it for resale. Therefore, if it's money out of your pocket, you're going to have normal income tax consequence. If it's retirement money, even with Roth money, you're going to be subject to some tax. I shouldn't say you, but the retirement account is. So if you're conducting business with your retirement account, even with a Roth IRA, you're going to be subject to that unrelated business taxable income. Your retirement account will be. So that's not a reason to do or not to do something. It's just something to be aware of. So you just got to factor that in as an additional issue with your return on investment. You just want to look at those numbers and make sure you're considering that piece of it as well. So if you want to flip properties for a living and you want to work on these properties, we're going to do a rollover business startup, because once again, a checkbook IRA nor a 401k plan is going to allow you to work on properties that you buy with the retirement account. That would constitute prohibited transaction in either situation. So if you want to buy property, you want to flip property for a living, you want to create a real estate investment business using a retirement account, we're going to do a rollover business startup, which is really simply a combination of a 401k plan and a C corporation. And then you literally can work on the stuff, take a salary. You've got a business that's there that's going to allow you to do what you need to do. So rollover business startup, what is it? As I said, it's a combination of a 401k plan and a C corporation. It has to be that combination. I don't want to see any combination of 401k and an LLC or any other mix. It's got to be a 401k and a C corp to work. Basically, we're going to take your retirement money and roll it into the new 401k plan. Again, we can't take Roth IRA money, nor can we take beneficiary IRA one that's been inherited and shove it into the 401k plan. So it's got to be traditional funds. Maybe it's a previous employer plan. And, keep in mind, we're in this sort of a turbulent time. Anytime we've gone through the last two issues, we've had lots of people lose their jobs. So when we talk about creating these accounts, when we talked about the 401k plans a while at the beginning of the presentation, you got to understand, if you lost your job or you've got a job transfer, you've got to access that money. That's when you need to do it. So make sure you're making those changes when they're possible. And I've had business owners even step away from their job for a period of time, get access to money because they had some investment they wanted to make and they weren't 59 and a half yet. So the rollover business startup works great. We've done it for everything from mattress companies. We did Alaskan fishing operations. We've done car dealerships, mining operations, lots of real estate investment companies, all kinds of different things. But this is the structure we're going to use if you want to go work in a business that's going to be owned by your retirement account. And it works great. We've got a couple examples for right now that we're going to be going through. So we talked about this. We do require, one thing I didn't mention is we want to see you personally as a shareholder of the corporation. So and not all your retirement funds have to be invested in the corporation either. So that 401k plan that's attached to the new corporation, it's still going to allow you to make other investments. We just want to have you personally invested into that C corporation to at least a level of 5%. So, and that's for several different reasons. Few examples, and then we're going to be wrapped up today. So in this situation, this actually happened. These are all real transactions. I don't put things into the presentations that we haven't done. So these are things that were done, and some of them were done. This one was done 14 years ago, probably. And in this situation, or actually maybe not that, maybe 12 years ago. But in this situation, a builder developer came to us. He wanted to use his retirement account as basically a land bank. So it was in Bend, and Bend is historically boom or bust. And so when it's going up, it goes nuts, and when it crashes hard. So, for those of you that remember some of the big developments that were happening, Remington and Pronghorn and all those over there, amongst many others, we had a situation where those lots were very, very expensive, and they went to virtually nothing, where they couldn't be given away. So this guy says, hey, I want to take my retirement account to buy this land because I know at some point it's going to be worth a lot of money again. I want to build on it in the future. So, we created a checkbook IRA. He went out and bought the dirt, and that's fine. Well, part B is he wants to develop it at some point. Well, he can't have his development company just build on those things. That would constitute a prohibited transaction unless we did a rollover business startup, which we didn't want to do. He didn't want to do it in this situation. So what we did is we created a second limited liability company. Our client with the checkbook IRA ended up a 1/6 owner of that second limited liability company. Therefore, at 1/6 ownership, that other limited liability company was not a disqualified party to his checkbook IRA LLC. So as things were to be developed, they'd be sold to the development entity that he was 1/6 member of. They'd build it out, sell it off, and his land bank would just keep buying new property. So the land bank, the checkbook IRA owned the dirt, and ultimately would sell the dirt to another entity that he was a 1/6 owner of when it was needed to be developed. And everybody got what they want, didn't have to pay the banks the carrying costs. Instead, the retirement account made a nice return, nice safe return, and hard assets that taxpayer knew inside out the values of. Invest in what you know. Second example. This is the fishing operation. Now, when we do a rollover business startup, so that previous example was a checkbook IRA. This is a rollover business startup. So he came to us and said, look, I need a couple of new commercial fishing boats and for my operation up there. So we ended up doing a rollover business startup. One of the big issues with rollover business startups, and I've mentioned it several times with, let's say, the 401k plans for a business, is that whatever the owner can do, everyone that's a participant in the plan has to be able to do. So a lot of times when we're doing rollover business startups, this is that taxpayer's first opportunity to own something. They always work for other people, and the last thing they want is for their employees to be buying into that company. So the natural reaction is, well, let's just say the investment in that business is fully subscribed. There's no shares left. They can't do it. Well, the government, that's how they attack rollover business startups. What's good for the big guy is good for everybody else. You can't say that. So if we're truly doing a new business startup, the plan can be drawn where there's a probationary period that the employee's got to be there for a period of time before they're able to participate. And you know, that works very well. So for new businesses, if we're talking about you buying a going concern, we don't have that ability to limit what's to be invested in. But in this gentleman's situation, you know, the nature of Alaskan fishing, for anybody that's done that in the commercial sense, is basically the guys go and, you know, sign on for the tour, make it through a season or make it through a trip, and they disappear. So he was not concerned about having anybody ever work in there long enough where you have to actually have them participate in the plan as well, which it's not a problem. As a business grows, you're going to have that. You're going to have to hire something called a TPA, a third-party administrator, as soon as you have other participants in the plan. And they're there really to keep the plan in compliance and keep you out of hot water. You don't want to have a situation where people are, you know, having issues there, you're doing something wrong. That TPA's job is to keep the whole venture moving forward and not have problems. So once again, if the business grows and you have to have employees, and now they've been there for a few years, and now they have the right to participate, that's not a huge problem. You just have to make sure that you've got a third-party administrator in place to cover the management of that situation. Next example, you know, this gentleman came to us. I love him, and he's a great guy. He had lots of real estate, lots of doors. And I apologize, some of these slides got reformatted when I converted. But we had a situation where, you know, in this situation, this guy came in and he wanted to buy this mobile home RV park. Then he started asking questions about making loans, buying notes, and that's what he ultimately wanted. He was tired of terrible T's, toilets, trash, tenants, turnover. So what he ended up doing is we did a checkbook IRA, and he ended up just buying notes. The first note he bought, this was the last crash once again, and during that crash, you know, this example, a $70,000 property in Palm Desert, pre-crash had been you know, $250. And he was he was going to finance the buyer's purchase, you know, 50% loan to value, paying him 11%. That's a pretty attractive loan. So once again, that's what he liked. He didn't want to deal with property ownership, so he just started rolling money in to the mortgage broker to place in loans, and he ended up moving several $1 million into us. I think the best note he bought was like a wind power note, and it was like $1 million note on a $10 million property, paying him, I think, 19%. And he wanted them to default in the worst way, I think, because that would have been an incredible investment then. Not that just the yield off the note wasn't enough in the first place. So all kinds of things you can do. And in this guy's case, he had lots of real estate, lots of doors, didn't really want to deal with more of it when it came down to it. So the notes were the perfect solution for him. So in this situation, guy came in, been working, got laid off, wanted to make some changes, and now he had access to money. So what he wanted to do is go buy a mattress store franchise, and that's what he did. So he took the money from his previous employer 401k plan, moved those funds into the new 401k plan. He had a personal investment, his ownership interest in the LLC. He had to get things going very quickly, so he went out and bought a couple of delivery trucks and had some other money. So the investment, so he had the 401k plan, make the investment in the new corporation, and then he had his personal investment in it was both cash and in kind. So he received shares attributable to the equity in the trucks and the additional cash he put in. And now he had that venture all set to go. Moving forward, you know, over a decade now, he's got additional franchises, and he's done very well with it. And obviously, it worked out. That was the olive branch of the future, and he made it happen, and it worked out to his benefit. So very happy with the situation in that scenario. This is an example of you know, basically using your retirement account as a life ring. So this was during the last crash. We had builder developer come to us. He had a $3 million piece of dirt with $1.2 million lien on it. If you remember back at that time, the banks were failing as fast as everyone else was. So the lender was going away, and if the lender went away, he had some issues with the loan. He was going to lose the loan, which meant he'd lose the property, and he didn't want to do that. So he asked whether or not he could use his dad's IRA to pay the property off, which you can't just take the IRA, you know, his dad's a disqualified party to him. And so therefore we couldn't just take the IRA and pay it off. So what we ended up doing is creating a new limited liability company. Junior contributed the property into the LLC, had an appraisal on the value. So Junior received a $1.8 million interest in the new LLC. Dad's IRA, at the same time, we did checkbook IRA for Dad, and that IRA made the investment in the LLC. So now that new LLC owned the property and had the cash to pay the property off. And ultimately, at a later date, they ended up going vertical, building out a multifamily project. But you know, long story short, we took a problem. He was going to lose that asset, ended up saving the asset and giving him the path to the future that he wanted. This is a situation where, you know, we're just looking at you know, how something's going to be owned, and the, you know, if we're looking at a property and a, you know, large, in this situation, exchange or relinquish large TIC property contain both tax and qualified funds. So we had, this is a real estate investment guy that puts tenancy in common investments together. And what happened is the previous investment went full cycle, so they were relinquishing it, tenancy in common, and it had both tax money, 1031 money, and qualified money, IRA 401k funds in the investment. So what happened is we peeled out all the IRA 401k funds because that's patient money. What I mean by that is 1031, anybody that's been through one, you only have 45 days to find what you want, 180 days to get it done. It's got to happen fast. So we had to peel out that money. We peeled out the qualified money, got the 1031 done, but we used the qualified money as debt on the replacement property. So those investors, they wanted to be part of the replacement property, but it was an improvement exchange, and we only had the 180 to get it done. So what we did is we created the acquisition, got it done. They ended up taking the qualified money as debt to go vertical on it. We used all that, and then at a later date, what happened is those notes ended up being converted to a membership interest in the LLC. So all the TIC members ended up buying in, and at a later date, the TIC was collapsed into a limited liability company. So those 1031 people were all members of the LLC. The debt on the property via the qualified money was converted from, it was convertible note to a membership interest in the LLC. Now that asset's owned by everybody that wanted to own it, and everybody got what they wanted. Now, if we go forward a few years, we're going to drop that thing, and ultimately this thing's gone full cycle too, just this year. Now it was ticked out again, and now once again the TIC members can go do what they want. The IRA 401k money, it goes and does what it wants yet again. So we have a situation where we can convert the ownership during time with seasoning periods. We can get people where they want to go. So maybe we can't do it right now, maybe it takes a year, maybe it takes 2 years, but that's where we're planning ahead and helping get people where they want to go. Now, this is the last example, and you guys are going to be free of me for the year, the last presentation of 2021. So I just love this example. This is an elder couple came to us with their 2 respective IRAs. This is an example. If you've been to my classes before, I always use this one. I just love it. They came to us, said, hey, we want to use our IRAs, go buy this mobile home RV park. And we started down the checkbook IRA path. Well, then they mentioned they wanted to live there and work there, be compensated. Well, obviously an IRA would not allow that. That's a prohibited transaction. It's going to blow up the IRA. So we shifted gears into the rollover business startup, created a new 401k plan. Each IRA was contributed to the plan, created a new CCorp. The plan bought the corp then negotiated the purchase of the park, made that purchase, and this couple got an investment, they got a job and a place to live, all with this one transaction, and I just love that story. I think it's tremendous success. So IRA Investors Checklist. Plan ahead takes 2 to 4 weeks to establish your self-directed IRA. I should change this slide, honestly. It probably should be 4 to 6 weeks these days. It's just crazy out there. You can purchase all types of property that IRA, SEP IRA, or Roth IRA can purchase with family members and friends, cannot purchase from or for them. Your IRA cannot sell to you or any other disqualified party. You can use an IRA to buy property with a mortgage, negotiate from the deal's inception in the IRA or IRA LLC's name. Do not overextend. Plan on keeping a nice cushion of reserves. And as I said before, real estate's not an alternative investment. It is a real investment. These are our websites, and please note, so we've got IRAadvantage.com or .net for our IRA business. 1031exchange.com is Equity Advantage for 1031s. Post 1031 is a property listing site. We've got these social media sites. If you've got questions on virtually, most virtually any item, IRA or 1031, I mean, take a look at our YouTube channels. And if you've got questions that aren't being answered with one of our videos up there, please don't hesitate to reach out. Reach out to Seymour at IRAadvantage.net, CMOORE at IRAadvantage.net. She'll be happy to handle any questions or comments you might have. But also, if you've got a request for a video on something you don't see up there, please let us know. We're happy to provide content. We like doing that. And thank you so much for your time today. Merry Christmas, happy holidays to everyone out there, and I'm gonna say good riddance 2021. I'm looking forward to a great 2022, and all my best to everyone out there. Thank you. David Moore, IRA Advantage, IRAadvantage.com. Thank you. Merry Christmas. Bye-bye.